click buy a few times before lunch, feeling confident, only to watch your account balance slide downhill by afternoon? Or perhaps you've patiently held onto a stock for 2 weeks and sold it out of frustration, only to see it skyrocket the very next day. Man, if you experience these gut-punching moments, chances are your trading style may be the culprit. Stick around, because today I'm going to break down 2 of the most popular trading styles, day trading and swing trading, in easy to understand steps, so that you can finally pinpoint which one fits your personality, your lifestyle, as well as your goals. So think of choosing your trading style as picking the type of meal you're preparing. Imagine coming home after a long, exhausting day. You might grab a quick frozen meal, pop it in the microwave, and within minutes, dinner is served. Quick, easy, and effective. That's day trading. Fast-paced, intense, and immediate. I like to call it today money. But maybe you prefer spending an evening carefully cooking a gourmet meal from scratch. You prep the ingredients thoughtfully, patiently wait for all the things to simmer, and you let the flavors blend to perfection. This is swing trading, a slower, deliberate process where you invest upfront, then step back and let the magic happen. And I like to say, let it sit and simmer. Both methods put food on the table, but each requires a different mindset as well as a different approach. So let's dive a little bit deeper. Choosing your pace when you're trading is really important. Some traders thrive on lightning fast decisions. Those folks are energized, capturing quick, small gains and rapidly moving into the next opportunity, sometimes placing dozens of trades in a single morning. They chase every flicker of market activity like gamers, racking up high scores. And on the flip side, others prefer planting seeds, nurturing them with careful research and patience, and waiting days, weeks, months, or even years for substantial growth. For these traders, open just 1 or 2 carefully chosen positions each month and let them grow steadily, trusting their thorough analysis. So, we really need to understand our risk tolerance, however, when we're deciding what we're going to do. So let's layer on your comfort with risk into this equation. Does even a minor drop of 2% trigger anxiety for you? Or can you calmly handle overnight swings of 10% or more? Your answer here is crucial, because trading against your risk tolerance can quickly lead to emotional exhaustion, frustration, or even worse, financial losses. One thing that's important to also consider are your tools. Fast traders rely on advanced setups. So think of it like multi-screen displays, sub-millisecond hotkeys, and live order flow charts that update every fraction of a second. Slow traders prefer simpler, clearer setups, daily charts, straightforward indicators and alerts, and carefully planned stop-loss formulas that trigger automatically. So mismatch your chosen tools to your personality, and you'll end up feeling overwhelmed, anxious, or entirely out of sync with the market. So let's talk about the difference between trading and investing, because they're 2 totally different games. Before diving into the specifics about trading styles, let's quickly clear a common confusion. Trading and investing are fundamentally different. So investors are like gardeners, like planting an orchard. They buy shares in well-established companies, so think Apple, Coca-Cola, or Microsoft, and they patiently nurture these investments over the years, banking on steady growth, dividends, and stable returns. So imagine Warren Buffett holding Coca-Cola stocks for decades. He's not worried about daily price movements. Traders, on the other hand, are more like surfers. They ride the short-term waves of the market, buying and selling stocks quickly to capture immediate profits. They may hold positions for minutes, hours, and most a few weeks, actually ready to jump off one wave into the next. And here's the bonus insight. In many countries, holding stocks for over a year can reduce your capital gains tax. So choosing a trading style not only affects your daily stress levels and routines, it can directly impact how much money stays in your pocket at tax time. So now that you understand the basics of your trading vibe, speed, risk tolerance, and tools, let's dive deeper into the specifics of day trading and swing trading in our next section. This way you can clearly see what style aligns perfectly with your life as well as your financial goals. So first, let's talk scalping. So scalping is for the fast and the furious trader. So what is it? Scalping is the most rapid-fire trading style designed to quickly capture tiny profits repeatedly throughout the trading day. So think of it like hit-and-run trading. Get in, grab a small gain, and get out within seconds or minutes. The capital requirements for scalpers, typically they maintain higher levels of capital because they're trading frequently. In the United States, if you execute 4 or more day trades within 5 trading days, you're going to be classified as a pattern day trader, which requires a minimum of $25,000. Your day as a scalper starts early. Even 7 in the morning, you check the overnight news, glance at today's economic calendar, and see which stocks are already moving in pre-market trading. While your coffee brews, you open up your platform, load level 2 quotes, and time and sales windows, and set hotkeys so one tap can place or close a trade in an instant. So when the opening bell rings at 9:30 a.m. Eastern Standard Time, then it's on and popping. You stare at bid and ask prices, look for tiny gaps you can exploit. Maybe you spot Apple showing a bid price of a certain number and an ask price of a certain number, and then you buy at the most opportune place. You hold the shares for 10 seconds and then sell it right away. 3 cents a share may seem small, but repeat that on a few thousand shares many times a day and the gains will add up. So at 4 p.m. the market closes and the screens finally slow down. You spend about an hour reviewing every trade, counting your fees, noting any slips, and adjusting tomorrow's plan while details are still fresh. Scalping only works if you love quick action, can stay glued to the screen for hours, and cut your losses the moment the trade turns against you. If that fast rhythm excites you instead of stressing you out, scalping could be your perfect fit. So now let's talk about day trading. This is the daily warrior. Day trading means opening and closing every trade within the same day. So no position stay in your account overnight, because US rules say anyone who makes 4 or more round-trip trades in 5 business days is a pattern day trader. You must keep at least $25,000 in your account. So a typical day starts around 7 a.m. You read overnight news, check the day's economic calendar, and look at pre-market volume to spot active stocks. By 9:30 a.m., when the market opens, you have a short list of names with clear news or strong chart patterns. In the first 15 to 30 minutes, you watch for opening range breakouts, entering a trade only if price moves beyond that early range and you have a clear entry, target, and stop loss. Late morning is quieter. You monitor any open trades, note what went well, and adjust plans if needed. After 2 p.m. volume often rises again, so you watch late day moves for reversals. Whatever happens, you close every trade before the 4 p.m. bell. After the market closes, you spend about an hour reviewing each trade, logging fees and results, and planning for the next day. So some common tools include opening range breakouts for early momentum, VWAP pullbacks for trades when price returns to a volume weighted average, news or earnings plays when headlines create sudden interest. For example, if Tesla gaps up 4% on strong earnings and then breaks above 15-minute high of 250, you might buy at 250.10. Place a stop at 249.50 and sell near 254 2 hours later for almost a 2% gain. Day trading suits you if you can watch the screen all day, prefer a quick but manageable pace, and handle frequent small wins and losses without losing focus. So now let's talk swing trading. This is the patient strategist. Swing trading is steady and is planned. Swing trading means holding a position for several days or even a few weeks, aiming to catch a larger price move than you would grab in a single session. The pace is calm. Instead of staring at the screen all day, You lean on preparation, well-balanced alerts, and patience. Because the pattern day trader rule doesn't apply, you can start your account with $5,000 to $10,000 and even less. Most of the real work happens during the weekend. You spend an hour or two on Sunday scrolling through weekly charts, flagging stocks with clear setups, and writing down where you enter, where the stop loss goes, and how far you expect the move to run. Once Monday rolls around, you're mostly supervising. After the close each evening, maybe 30 minutes, rarely more than an hour, you check your open trades, nudge a stop bit tighter, or lock in part of a profit. During market hours, you're free to focus on your day job. Most swing trades fall into one of three familiar setups. One is the earnings drift move. After a company beats estimates, its stock often keeps inching higher for several sessions, and you ride that follow through. Another is a classic momentum breakout where clean chart patterns, think bull flags, cup and handle bases, or ascending triangles signal the start of a new push. Your risk stays tight. Swing traders usually limit single trade to about 1% of total capital. To set the stop, you look at volatility with a tool called average true range. If a stock normally swings $2 a day, you place your stop about $2 below the entry, tying risk to real price movement instead of guesswork. Swing trading fits anyone with a full-time schedule who still wants market exposure. If you like planning ahead, don't mind holding overnight, and can accept the occasional gap against you in return for a calmer routine, this style may be exactly what you're after. So now that we've explored the ins and outs of scalping, day trading, and swing trading, it's time to pull back the curtain on what trading looks like day to day, including real-world challenges, psychological demands, financial costs, and profitability expectations. So let's start with something traders often overlook early in their journey: the hidden costs behind each style. So first, let's start with scalping and day trading costs. Frequent traders often face two key expenses. Even if fees per trade are low, frequent small trades can add up rapidly. For example, placing 50 trades per day at just 50 cents per trade equals $25 a day, or roughly $500 monthly. There's also this thing called slippage. This occurs when you don't get your ideal price. Buying at 10.05 instead of 10.03 seems minor, but multiply over thousands of shares per day, that difference quickly adds up. So for example, if Shayla scalped 10,000 shares daily at 0.002 per share commission, she's spending $20 every day, every trading session. Multiply that by 20 sessions a month, and she's paying $400 in trading costs. When we think about swing trading costs, swing traders typically avoid high daily commissions but face other costs. It could be margin interest. So if you're using margin, which is borrowing money from your broker, overnight costs typically cost around 7 to 13% annualized. They can quietly eat into your profits. Also, there's holding risk. Although not monetary, holding overnight positions exposes you to unexpected gaps, sudden price jumps or falls from overnight news events. So for example, if Mark swing trades a $10,000 position using margin, paying 10% annual interest, holding it for 1 month costs around $83, but this must factor into his profit calculations. Let's face reality head on. Trading profitably over the long term is challenging, and most traders underestimate the odds. So let's talk about scalping and day trading stats. Research consistently shows fewer than 3% of active day traders remain profitable after 5 years. The low number arises because of high emotional demands, heavy transaction costs, and the constant mental intensity required. So let's talk about some swing trading stats. Approximately 10 to 15% of disciplined swing traders outperform passive investing over extended periods. The advantage here is less emotional exhaustion, clear trade management, and lower cumulative trading costs. So something that's important to note is that even successful traders experience prolonged losing streaks. Some traders survive these periods by managing risk, limiting losses, and maintaining psychological composure. So here's a vital lesson about trading as well as investing. Missing even 10 of the market's top performing days each year can dramatically reduce overall profits. And why is that? The market's biggest gain usually follows significant volatility moments when most traders panic or they just simply sit it out. So whether day trading or swing trading, consistent exposure rather than trying to time every perfect entry is crucial. Developing disciplined risk management habits help traders ride volatility rather than be afraid of it. Choosing a trading style is personal, so run a quick self-check first. Think about the time you can truly set it aside. If you can stay at the screen all day, day trading may fit. But if you only have an hour at most in the evening, a block of time on Sunday, swing trading is more realistic. Next, look at how you react to risk. Do price swings make you nervous, or can you watch them without flinching? Also notice what kind of stress bothers you more. If the idea of waking up to an unexpected gap down keeps you up at night, swing trading might feel rough. If taking a string of small intraday losses wears you out, day trading could be a tougher path. Finally, ask what actually energizes you over the long run. Do you enjoy constant action or instant feedback, or do you prefer quiet planning through patient follow-through? Your honest answers will point you toward the style that truly matches your temperament as well as your schedule. So regardless of your chosen style, success relies heavily on the following foundational skills. First and foremost, risk management. Limit each trade's risk, usually less than 1 to 2% of your account, and strictly enforce your stops. The second is emotional discipline. Stick to your plan, all right? Avoid impulsive moves. Develop self-awareness around emotions like greed and fear. Also, journaling and review is really important. Maintain a detailed trading journal to analyze patterns, mistakes, and successes. Refine your strategies continuously. Master these basics first, and then your chosen style will genuinely flourish. By now, you should have a clear vision of what scalping, day trading, and swing trading realistically look like in terms of cost, psychology, sustainability, as well as lifestyle. Trading can indeed become a fulfilling, profitable career, but only if you match it carefully to your personality, your goals, and your life circumstances. If you found this video to be helpful, go ahead and tap the like and hit subscribe button, and in our next section, we'll craft your personal rock-solid trading plan to safeguard your capital and build consistent profits. Also, drop the word school in the comments, and when you do, I'll personally send you an invite to my Insiders Club, a powerful community designed to help you to level up and start winning in these stock market streets step by step. Until then, protect your capital, manage your risk wisely, and trade confidently. You got this, all right? So let's go get it.